A very good evening and a warm welcome to Personal Finance. I'm Gugulethu Cele. Now today I'm joined in our Cape Town studios by Philip Fora, who's a global head of wealth planning and philanthropy at Standard Bank Wealth and Investment. Now he joins us to give us an idea of actually understanding what your wealth quotient or wealth IQ actually is and how to interpret that to have a more efficient financial plan. Philip, good to have you with us this evening and thank you so much for your time. I guess the first place to start before understanding how to interpret your wealth IQ or wealth quotient is actually for you to give us a brief understanding as to what a wealth quotient is.
Yes, super. Thanks, Gugu, and thanks for having me on the show. I think, the background to it is it's time the industry actually relooks at the meaning of wealth. I think we've moved quite far down the line where people are very focused on the product-driven approach to advising clients, and often you end up with just doing a straight financial needs analysis, which puts the client in a certain risk profile, and he ends up in an aggressive or a medium risk portfolio. And then, of course, we just reduce the relationship to a report which talks about returns and risks and references to a particular benchmark. I think we've lost the road a bit. We need to go back to, what's the meaning of money for clients? What does this mean? What are the aspirations, goals, and ambitions of every single client when it comes to their wealth? So we've got to go back to that. And we've come up with this concept, I suppose, or this way of looking at money called the wealth quotient. And the background to that is just like each one of us have a unique IQ or intelligent quotient and a unique EQ or emotional quotient, we've come up with the now wealth quotient. And the concept really is every one of us has a unique outlook on wealth and what that means to us. So us as advisors need to sit down with every single client and take them through a process of looking at their wealth differently, to break it down into the different aspects of their life, how they make their money, how they live and spend their money, how they preserve for the future, and of course their legacy wealth as well. And we sit down and put goals around all of that, give them a visual of what that looks like right now, and most importantly, then partner them over a lifetime to make sure that they achieve those goals and ambitions. So it's really just putting a lot more meaning and purpose, I guess, towards their wealth.
On that, though, I take it's obviously not advisable for an individual to try to determine their wealth quotient by themselves. Does this call for the need of a certified financial planner or wealth manager to actually walk them through this concept and understanding where their needs actually fall into?
I think, importantly, wealth advisors bring independence or objectivity to the conversation. And a lot of people are, when it comes to your wealth, you're very emotional about that wealth. And it's difficult to be objective when it comes to talking and dreaming and planning around it. So the guidance is essential. And of course, the qualifications to give advice on what are the appropriate solutions for every aspect of your life. And of course, then it's the partnership long term on that journey, which is essential.
If we do go back to the basics, I take it you need to have a sense of wealth, first of all, before we can take this journey going forward. So how does one actually build up wealth efficiently?
Absolutely. The journey starts, of course, with making money, because, of course, the rest of the conversation is irrelevant if we don't have any to invest. So, our business is very much around partnering clients at different life stages. Now, your 40-year-old is very focused on making money. He's very focused on his business or his career, and our role is to make sure he's focused on that and support him in that wealth creation journey. Of course, once he's then created the wealth, he starts to, obviously the lifestyle becomes important. He wants a bigger home and a car, etc., and it's supporting him in that stage of life. Your 50-year-old, of course, he starts to think about the future. Suddenly the retirement years are approaching. The sort of 60, 65, so the saving for the future becomes essential, and there the conversation must move towards retirement planning or how he's going to exit his business. And then, of course, the client that has retired, the conversation is very different. How do we support them on preserving their lifestyle and, of course, leaving a legacy, the wealth that potentially will be left behind after they are no longer here.
To stick back to the first two issues that you mentioned, apologies to interject there, Philip, but building the wealth as well as preserving the wealth, does this also need a significant investment strategy? And top of mind, one would think that the best kind of exposure you can get would be in equities. Would this count?
So, in the building wealth, that's really what you do for a living every day. Each one of us have different focuses. An entrepreneur has a very different journey to building wealth compared to a corporate person, and of course very different to a professional like a doctor or a lawyer. So our role as an investment advisor is to support him on that journey, and often that comes down to, well, how can we facilitate potential lending to help him buy equity in his business, or grow or expand his business, or get access to share options, or if it's a doctor's practice, buy new equipment, or dentist practice. So making money, or the journey to wealth creation, is very focused on what you do for a living, and that's how we will support clients in creating wealth. Of course, when it comes to then preserving wealth, that's very different. That's where you start taking some wealth off the table. You start saving. If you've got your own business, you hopefully accumulating dividends, or if you're approaching at some point in the future a sale, it's about taking the proceeds of that sale and putting that to work for you in the future. So the preserving wealth, absolutely, that's where the likes of investments come into play, and one needs to build a really detailed strategy around that. Your equities, as you referred to, of course, that's a vital part of any portfolio, really. But that's got to be viewed in the long term. That's a sort of 5-year plus money, where you've got to build up the real returns. And as we know, over the long term, equities do outperform most other investment types. So equities will form a large part of any client's portfolio. But of course, you've got to provide for the short and medium term liquidity and limited volatility in a portfolio as well. So the preserving wealth is a really detailed process, and that's where your advisor plays an absolutely essential role.
I'm so happy you touched on the outlook with regard to these investment opportunities, Philip, because again, it also means that despite having the long-term outlook, but you also need to be fairly flexible and in constant discussion with your wealth manager, given changes that take place in your life. Is this also advisable for consumers out there, that constant open communication with your financial advisor should any significant changes in your life take place?
What's critical is that you have a really good relationship with your advisor. I think it's a partnership. What you don't want is to be put into some sort of product, particularly which pays a large fee up front or an ongoing commission, and there's no ongoing service. Your financial advisor is absolutely committed, has to be committed to partnering you and reviewing that solution on an ongoing basis, because yes, your circumstances are going to change, they will change. So at least once a year you should be reviewing the advice given to you, and of course at least on a quarterly basis having an update on how you're doing. But what's important is no knee-jerk reactions in a portfolio, particularly in volatile times like we're seeing at the moment. The worst thing you can do is panic and sell out of your portfolio. That's often where you lock in losses and do long-term damage. So it's essential that your advisor plays that objective role in your life.
So true. I'm happy you touched on that too. But given the fact that you mentioned again that the wealth quotient is on a very unique individual basis and not a cookie cutter approach, if I can use that phrase, does this mean that the cost implications of understanding your wealth quotient and the kind of advice you receive means that you might be forking out a little bit more than your peers for this specialized kind of advice?
Not necessarily. In fact, not at all. I think it's part of any advice process. It's just the way you need to look at your wealth. It's an approach we take. I think any fees that one earns is in line with the market, and of course takes into account the underlying solutions, products, services that you are going to use in your journey. But the actual advisory process doesn't come at a cost. It really ends up in the solutions that's put together for you.
Let's revolve now to the last element of the conversation, which you did mention is not only building up the wealth, preserving it, but also ensuring that there's a progression going forward and leaving the wealth to some of your dependents. How do we ensure that that takes place efficiently without your estate duties and those kind of taxes eating too much into the pie that you leave behind?
So it's a very interesting subject, and often the great conversation to have with clients. You know, a lot of the clients we deal with at Standard Bank Wealth and Investment are in that sort of space where they have wealth that will probably be around long beyond their lifetime. And what's important to have is to have the conversation today. You know, you're going to have this excess wealth, Mr. Client. What should we do with it today? Let's think about the future. Let's talk about the succession planning. You know, that's where the likes of trust can play a hugely important role in transitioning wealth between generations, both local and offshore. And of course, the conversation must start with how much do you want to leave for your children and for others in the family, and that's an important discussion to have. Sometimes leaving it all is not a good idea, might just create dependence. Or is it important for you to make a difference in the world? And that's where philanthropy comes into play. And we assist clients in putting together a strategy, building a foundation, and then having those funds last in perpetuity potentially to support a particular good cause. And then, of course, what's important is making sure that any beneficiaries, particularly children, are well equipped to deal with wealth. And as a business, we've recently started some leadership academies. We have the Future Leaders Academies for kids between the ages of 17 and 27, young leaders and junior leaders, which deal with kids in the younger ages. And then we've got a Women Leaders Academy, where we work with the family members on a journey of understanding wealth better. Also, we're talking about creating wealth and saving wealth and spending, and of course, legacy planning or philanthropy. So absolutely important to educate family members on the future of their wealth.
So true. Importance of education from a financial perspective. Well, we've certainly said quite a bit, Philip, but let's get a quick recap now on the key takeaways from tonight's discussion. Philip, back to you. For the viewers who have been watching tonight and want to know a little bit more about understanding their wealth quotient and the kind of questions that they need to be asking their wealth manager or financial advisors, where should they begin and what should the questions entail?
I think the most important is to make sure you have a really good wealth manager or financial planner that works with you and is there to properly understand you and put you at the center. And he's not there to sell a product or make a commission or an ongoing trail fee. And those days are coming to an end. So, selection of the right advisor is an important process. Secondly, I think it's important the advisor must understand you and your goals and remove the conversation around benchmarks and performance and risks and understanding what it is you want to achieve in life, and then building the appropriate solution around that. I think we also need to move away from the straight single dimension risk assessment. Mr. Client, you are a medium or low risk. We need to understand what sort of risk you may need to take to maintain your lifestyle and the capacity to take risks. So really look at how we view risk. And then I think it's important to understand your longer term plans, your legacy planning, what you want to do with wealth beyond your lifetime, if that's appropriate in your circumstances. Not leave it to chance once you're no longer around.
Thank you so much for your insightful analysis, Philip. We certainly do appreciate your contribution to tonight's conversation. A big thank you once more to Philip Forer, who's the Global Head of Wealth Planning and Philanthropy at Standard Bank Wealth and Investment, for joining us this evening. Well, that's how we wrap things up from our view of personal finance tonight. And if you have further questions or would like to share your views on other topics that we can touch on the show, go ahead and tweet us at CNBC Africa using the hashtag Finance410 or myself at Gukumfupi. Until next time, have a wonderful evening.